Well, hello there, NASDUCK listeners. We have a doozy to unpack today, so pour yourself something strong. We're about to talk about something that might just be the biggest institutional crisis of our lifetime. And I'm not being dramatic here. We're talking about the very real possibility that our sitting president might actually fire Jerome Powell, the Fed chair. And if you think this is just another political sideshow, you're dead wrong. This could reshape everything we thought we knew about American finance. Now, before we get started, let me remind you why you listen to this podcast. After 20 years on Wall Street, watching the sausage get made from the inside, I've seen exactly how this game is rigged. And today we're going to talk about what happens when the riggers start fighting each other. You know, it's funny. Here I am, a guy who spent 2 decades helping the ultra-wealthy get ultra-wealthier, and now I'm sitting here trying to help regular folks navigate a system that was literally designed to fleece them. The irony isn't lost on me. But that's exactly why you need to hear this stuff from someone who knows where the bodies are buried. So let's talk about Jerome Powell. This guy, for better or worse, has become the most powerful economic figure on the planet. More powerful than any Treasury Secretary, more powerful than most heads of state when it comes to global finance. And our current administration is seriously considering firing him over what amounts to a renovation budget dispute and some hurt feelings about interest rates. Let me paint you a picture. Trump, and I'm going to call this what it is pissed that Powell won't play ball with his political timeline. The president wants lower interest rates, and he wants them now, not because it's good economic policy, but because it would goose the markets and make him look good. Classic short-term thinking that puts politics ahead of economic stability. That's where you need to pay attention as an investor. The stated reason for potentially firing Powell isn't monetary policy, because legally, you can't fire a Fed chair just because you disagree with their decisions. No, the pretext they're using is this $2.5 billion renovation of the Fed building in D.C. Now, $2.5 billion for a building renovation? That's obscene by any normal person's standards. But let's be real, this is the same government that spends $700 billion a year on defense and somehow can't figure out how to provide health care to its citizens. The Fed building renovation is chump change in the grand scheme of federal waste. But it's politically useful, so that's what they're hanging their hat on. Legally, it's fascinating and terrifying at the same time. Technically, Fed governors serve 14-year terms and can only be removed for cause. That means serious misconduct, not policy disagreements. But the law isn't crystal clear about whether the chair role specifically has the same protection. It's never been tested because no president has ever been crazy enough to try it. And that's what we're dealing with here, folks. Uncharted territory, the kind of constitutional crisis that makes markets very, very nervous. Now let me tell you what's already happened just from the speculation. When rumors started flying that Powell might get the axe, the S&P 500 dropped nearly a full % in minutes. The dollar weakened, long-term bond yields spiked, and even Bitcoin had a little freak out. And this was just from rumors, mind you. Imagine what happens if it actually goes down. The market reaction tells you everything you need to know about who really runs this country. The president? Nope, strike 1. The Congress? Far from it, strike 2. The financial markets? Bingo. The moment Wall Street gets spooked about Fed independence, suddenly everyone's scrambling to reassure investors that everything's fine. You want to talk about who has real power in America? Bond vigilantes, currency traders, people who can crash the dollar or spike interest rates just by collectively deciding they don't trust the system anymore. So we're supposed to live in this great capitalist democracy, right? But what we actually have is a system where unelected central bankers have more power over your daily life than any politician you'll ever vote for. Powell can raise rates and suddenly your mortgage payment goes up, your 401k tanks, and your job might disappear. But did you vote for Jerome Powell? Hell no. Think about it. The Federal Reserve is a quasi-private institution that controls the money supply of the world's largest economy. It's owned by private banks, but it has government-like powers. It's capitalism when it benefits the banks, and it's socialism when they need bailouts. It's the perfect representation of how screwed up our economic system really is. Now, I'm not saying Powell is a bad guy. In fact, compared to some of the Wall Street cronies who could replace him, he's probably one of the better options. But the fundamental issue here isn't about Powell personally. It's about the entire structure of how monetary policy works in this country. Think about it this way. Every time there's an economic crisis, what happens? The Fed steps in and floods the system with money. So where does that money go? Primarily to big banks and major corporations. They get to borrow at near zero rates while you're paying 18% on your credit card. They get bailouts when their risky bets go wrong while you lose your house when you can't make the payments. This is socialism for the rich and brutal capitalism for everyone else. And firing Powell won't change that fundamental reality. If anything, it'll make it worse. What are the experts saying will happen if Powell actually gets fired? First, you'll see immediate market volatility. Stocks will tank, at least initially. Long-term bond yields will spike because investors will demand higher compensation for the increased political risk. The dollar will weaken because global investors will start questioning whether the U.S. is still a stable place to park their money. This is where it gets really scary for regular investors. If the Fed loses its independence, if it becomes just another political tool, then inflation becomes a much bigger long-term threat. Because what do you think happens when every president can pressure the Fed to keep rates artificially low? You get exactly what happened in the 1970s. Runaway inflation that destroys savings and wages. And who gets hurt most by inflation? Well, if you've been paying attention to what I've said so far, you know it's not the wealthy. They own assets that tend to appreciate with inflation. Real estate, stocks, commodities. It's working people with savings accounts and fixed incomes who get absolutely crushed. So we've got this perverse situation where the threat to fire Powell could actually lead to policies that hurt the very people Trump claims to represent. But that's politics for you. Short-term thinking that creates long-term disasters. Let's talk about the reason you're here. You want to know what this means for your portfolio. The immediate reaction to any Powell firing would be ugly. Think of it as the market throwing a tantrum. Growth stocks would get hammered because higher long-term rates make future earnings less valuable. Tech stocks especially would be in for a rough ride. Bonds are where it gets really interesting. You'd see this weird situation where short-term rates might actually fall because markets would expect a new, more dovish Fed chair to cut rates aggressively. But long-term rates would spike because investors would be pricing in higher future inflation. This kind of yield curve steepening is like a neon sign flashing economic instability ahead. The dollar weakness is actually one of the more predictable outcomes. If global investors start questioning American institutional stability, they'll move money elsewhere. That's great if you own international assets, but it makes everything you import more expensive. And guess what? We import a lot of stuff. Cryptocurrencies are the wild card here. On one hand, market turmoil usually hurts risk assets like Bitcoin. But on the other hand, if people start losing faith in traditional institutions, crypto could benefit as an alternative store of value. It's one of those situations where the second-order effects might be more important than the immediate reaction. What I want you to really understand about this whole situation is that our entire financial system is fragile, for lack of a better word. We've built this massive, complex economy that depends on confidence and trust, and we're watching political actors casually threaten to blow it up for short-term political gain. This is what happens when you have extreme wealth inequality and a political system that's completely captured by special interests. The normal checks and balances break down because the incentives are all wrong. Politicians don't care about long-term economic stability because they're focused on the next election cycle. And the wealthy don't care because they're insulated from the consequences. It's the perfect example of what I call privatized gains and socialized losses. When things go well, the profits flow upward. When things go badly, the costs get dumped on the taxpayers and the middle class. And that brings me to another question. What would a truly democratic economic system look like? What if, instead of having a few unelected technocrats controlling monetary policy, we had institutions that were actually accountable to working people? Now, I'm not talking about politicians directly controlling interest rates. That would be a disaster. But what if we had a Fed that was explicitly mandated to prioritize full employment over price stability? What if we had banking regulations that actually prevented too big to fail institutions from gambling with the economy? What if we had a system where ordinary people had a real say in economic policy? I know, that sounds radical to American ears. But look around the world. Countries like Denmark, Norway, and Germany have much more democratic control over their economies, and guess what? Their people are happier, healthier, and more economically secure than we are. The dirty secret that Wall Street doesn't want you to know is that our current system isn't actually capitalism. It's crony capitalism, or what some economists call corporate socialism. The risks are socialized through government bailouts and Fed interventions, but the profits remain private. It's the worst of both worlds for regular people. But I'm getting ahead of myself here. Let's get back to the immediate situation with Powell and what you should be doing with your money right now. First thing, and I cannot stress this enough, do not make drastic portfolio changes based on political theater. Yes, there's real risk here, but we've seen this movie before with Trump. He threatens dramatic action, markets freak out, and then cooler heads usually prevail. The guy thrives on chaos and attention, and firing Powell would give him both. That said, you should be positioning your portfolio for higher volatility. That means having some cash on hand to buy opportunities when they present themselves. It means being diversified across asset classes and geographies. And it means being prepared for scenarios that most people aren't even considering. One thing I'd definitely be looking at is international exposure. If the dollar weakens significantly, foreign assets become more attractive. European and Asian markets could outperform if global investors start fleeing U.S. assets. And don't overlook emerging markets. They've been beaten down for years and could see massive inflows if the dollar loses its safe haven status. On the fixed income side, I'd be very careful about long-term treasury bonds. If long-term rates spike, those are going to be absolute portfolio killers. Better to stick with shorter duration bonds or treasury inflation-protected securities if you want government exposure. Real assets are where things get interesting. If we're looking at a potential inflation scenario, you want to own things that hold their value when currency loses purchasing power. Real estate, commodities, infrastructure, these are the kinds of assets that have historically done well in inflationary environments. And yeah, I'm even warming up to having a small crypto allocation. Not because I think Bitcoin is going to replace the dollar, but because in a world where traditional institutions are under attack, having some exposure to alternative stores of value makes sense. Just keep it small, 5% max. This Powell situation is a symptom of a much larger problem. We have an economic system that's fundamentally unstable because it's built on ever-increasing debt and inequality. The Fed's main job has become keeping asset bubbles inflated so that wealthy people don't lose money. That's not sustainable indefinitely. At some point, we're going to have to reckon with the fact that our current economic model doesn't work for most people. Wages have been stagnant for decades while asset prices have soared. Young people can't afford houses, retirement is becoming impossible for huge numbers of workers, and meanwhile, billionaires are literally shooting themselves into space for fun. This isn't about left versus right, Democrat versus Republican. Both parties have been complicit in creating this mess. It's about whether we're going to continue with a system that concentrates wealth and power in the hands of a tiny elite, or whether we're going to build something that actually works for working people. And I want to be clear about something. When I talk about alternatives to our current system, I'm not talking about Soviet-style communism or anything like that. What I have in mind is the kind of mixed economy that most successful countries already have. Strong public institutions, robust worker protections, universal health care, and, yes, still plenty of room for private enterprise and innovation. The idea that we have to choose between McCarthy and Stalin is a false choice that's been pushed on us by people who benefit from the current system. There are dozens of successful economic models around the world that blend the best of both approaches. Back to your immediate concerns as an investor, please understand you can't depend on political stability in your investment planning. We're living in an era of increasing institutional breakdown, and that's going to create both risks and opportunities. The risks are obvious: higher volatility, potential currency instability, the possibility of policy mistakes that create economic chaos. But the opportunities are real too. Periods of institutional change often create massive wealth transfer, and if you're positioned correctly, you can benefit rather than get crushed. The key is to think like the ultra-wealthy think. They don't put all their eggs in one basket, they don't depend on any single government or currency, and they're always looking for ways to profit from chaos. That might sound cynical, but it's reality. One thing I've learned in my years on Wall Street is that the people who make the most money during crises are the ones who prepared for them in advance. They had cash when everyone else was leveraged to the hilt, they had international exposure when domestic markets collapsed, they owned real assets when currencies devalued. So, what does that mean practically? It means having a portion of your wealth outside the traditional US dollar system. Own assets that can't be printed by central banks and be prepared for scenarios that your financial advisor probably isn't even considering. Also, understand that the current system is designed to transfer wealth from regular people to the already wealthy. The sooner you accept that reality, the better you can protect yourself and potentially profit from it. You know what that most financial commentators won't touch? The class warfare aspect of Fed policy. Every time the Fed cuts rates or implements quantitative easing, it's essentially a massive wealth transfer from savers to borrowers, from the middle class to asset owners. Think about it. When rates are near zero, who benefits? People who own stocks, real estate, and other assets that appreciate when money is cheap. Who gets hurt? People with savings accounts, retirees on fixed incomes, young people trying to buy their first home. This is why I get so frustrated when people talk about Fed independence like it's some sacred principle. Independent from what? Independent from democratic accountability? Because that's what we have, a system where the most important economic decisions are made by people who are completely insulated from the consequences of their choices. Jerome Powell doesn't have to worry about paying rent or making car payments. None of the Fed governors do. They're all wealthy. They all come from the same elite circles, and they all have the same class interests. And we're supposed to pretend that their independence is somehow protecting regular people? The real independence we need is independence from Wall Street influence. But that's never going to happen as long as the Fed is literally owned by the banks it's supposed to regulate. It's like asking the foxes to guard the henhouse and then being surprised when the chickens keep disappearing. This is why I've become increasingly convinced that we need fundamental structural changes to how our economy works. Imagine a Federal Reserve that was actually owned by the people, not the banks, with monetary policy that prioritized full employment and wage growth over asset price stability. And how about a banking system that serves communities instead of extracting wealth from them? These aren't radical ideas if you look at how other countries structure their economies, but in America, we've been so brainwashed into thinking that any alternative to our current system is automatically hammer and sickle. Well, let me tell you something. If you're not a socialist but believe that working people should have a say in economic policy, that essential services should be provided to keep everybody in good shape and not to make money off them, and if you think we deserve all this massive wealth could be distributed more fairly, then it might be time to reconsider your definition of socialism, because that's exactly the definition of that word. Folks, let's face it, what we have now sure as hell isn't working for most people. We have the highest healthcare costs in the world, the least vacation time, the worst worker protections, and the greatest inequality of any developed nation. And we're supposed to be grateful for this system because it makes a few people incredibly wealthy? The Powell firing threat is just the latest example of how our current system puts short-term political considerations ahead of long-term economic stability. And it's going to keep happening as long as we have an economic system that's fundamentally undemocratic. But enough of my soapbox. Let's talk about some specific strategies for navigating this mess. First, you need to accept that traditional portfolio theory probably doesn't apply in the current environment. The old 60-40 stock-bond allocation was built for a world of stable institutions and predictable monetary policy. We don't live in that world anymore. Instead, you need to think about portfolio resilience. What assets will hold their value regardless of what crazy stuff happens in Washington? What investments will benefit from the breakdown of traditional structures? I'm increasingly convinced that the biggest opportunities are going to be in areas that most mainstream investors are ignoring. Local businesses that serve real community needs, cooperative enterprises that distribute ownership broadly, investment funds that prioritize social and environmental impact alongside financial returns. These might not be the highest returning investments in the short term, but they're building the foundation for a more sustainable economic system. And more importantly, they're aligned with your interests as a working person rather than against them. Another thing to consider is skills and education as investments. In an era of rapid change, the ability to adapt and learn new things is going to be more valuable than any particular asset class. So it's both technical skills and understanding how economic systems work that I'm talking about, how power operates, how to organize with other people to create change. The wealthy have always understood that knowledge is power. They send their kids to elite schools to get educated, but also to network, learn how the system really works. Well, guess what? That information is available to everyone now if you know where to look. Which brings me to media literacy and information warfare. The Powell firing story is a perfect example of how financial media manipulates public opinion. You'll notice that most mainstream coverage focuses on the technical and legal aspects, not the deeper questions about democratic accountability and systemic reform. That's not an accident. The people who own major media companies have a vested interest in maintaining the current system. They don't want you asking fundamental questions about why we structure our economy the way we do. So when you're consuming financial news, always ask yourself, who benefits from this narrative? What perspective is being left out? What alternatives aren't being discussed? And speaking of alternatives, let me share something that most people don't know about the Federal Reserve's history. It wasn't always structured the way it is now. In fact, the original Federal Reserve Act included much more democratic oversight and regional representation. But over the decades, power has been increasingly centralized and insulated from public accountability. There's no reason we couldn't return to a more democratic structure. There's no reason we couldn't have Fed governors elected by regions rather than appointed by the president. There's no reason we couldn't have worker representatives on the Federal Open Market Committee alongside banker representatives. These kinds of structural changes would make monetary policy more responsive to the needs of working people rather than just asset owners. But they'll never happen unless people start demanding them. And that's the real lesson of the Powell situation. It's not enough to just manage your portfolio defensively and hope for the best. If you want a system that works for you instead of against you, you have to be willing to get involved in changing it. Now, I know what some of you are thinking. Rick, I just want to make money and retire comfortably. I don't want to become a political activist. And I get that. I really do. But the reality is that in the current environment, staying out of politics is itself a political choice. It's a choice to accept the status quo and hope it doesn't completely fall apart before you die. But what about your kids? What about their kids? Are you really okay with leaving them a world where a tiny elite controls all the wealth and everyone else fights for scraps? Because that's where we're headed if current trends continue. The statistics are stark. Wealth inequality is at levels not seen since the 1920s. Social mobility has collapsed, and trust in institutions is at historic lows. This isn't sustainable. Something's going to give, and it's going to give in the next decade or two. The question is whether that change comes from organized popular movements demanding democratic reforms, or whether it comes from the system simply collapsing under its own contradictions. I'd rather see the first option personally, but that requires people like you, people with some wealth and education and influence, to start thinking beyond just protecting your own portfolios. Okay, let me wrap this up with some concrete advice for the next few months as this Powell situation plays out. First, expect more volatility. The administration is clearly testing the waters to see how markets react to threats against Fed independence. They're going to keep pushing until they either get what they want or face real consequences. Don't assume that cooler heads will prevail. We're dealing with people who have shown repeatedly that they're willing to break norms and institutions to get their way. The fact that something hasn't happened before doesn't mean it won't happen now. You need to prepare for multiple scenarios. Have some cash for opportunities, have some international exposure for dollar weakness, have some real assets for inflation protection, and have some alternatives for systemic breakdown. It's time to start thinking about investments that align with your values, not just your financial goals. The transition to a more democratic economy is going to happen one way or another. You can either be part of building something better, or you can be part of the problem. My advice is to educate yourself about alternatives, read about how other countries structure their economies, learn about cooperative businesses and public banking. Understand what democratic socialism actually means, not what corporate media tells you it means. The Powell situation is just one symptom of a much larger systemic crisis. The sooner you understand that, the better prepared you'll be for what's coming. And with that, folks, I'm going to wrap up today's podcast. As always, this isn't financial advice. I'm just a guy who's seen too much and wants to help people navigate an increasingly crazy world. If you found this useful, share it with someone who might benefit. The system may be rigged, but that doesn't mean you're powerless. Knowledge is power, and you've got more of both than you think. Until next time, this is Rick Sullivan reminding you to stay informed, stay skeptical, and for God's sake, don't trust anyone who tells you the current system is the best we can do. We can do better. We have to do better. And we will do better, as long as enough people wake up and demand it. Take care of yourselves out there.